Assalamualaikum warahmatullah. Welcome everyone. In this presentation, we will be discussing on how to treat financial liabilities, specifically bond. For this presentation, you should read together two standards, MFRS 9 Financial Instruments and MFRS 132 Financial Instruments Presentation. However, the majority of the discussion will be referring to MFRS 9. You also need the present value table and present value annuity table provided in Putra Blast. Please make sure you have them ready with you before continuing with this video. Please also note that bond is specifically chosen as an example of financial liability for this discussion because it is one of the easiest form of financial liability that you could understand, given that at this point you have not taken any finance courses. In finance courses in the future, you will come across various different types of financial instruments, either assets or liabilities. Also, you should already discuss another financial liability example in previous FAR course, which is loan, either short or long term. Therefore, it will make the discussion smoother since bond is somewhat similar in nature with loan. For this discussion, we will be tapping on few questions. What is financial liabilities? That is, we'll be looking at the definition. When do you recognize it? That is the initial recognition. What amount to recognize? We will look at the measurements at recognition and how to measure its carrying amount, i.e. the subsequent measurement. For definition, we will need to refer to MFRS 132 Financial Instruments Presentation. Before you look at the definitions of financial liability, let us first understand financial instrument. Three keywords to remember. Any contract, this means that it should be binding either in writing or orally. The contract should give rise to financial assets of one entity and, at the same time, financial liability or equity of another entity. So there should be two different entities, and within the context of this standard, entity here referring to not just firms but also individuals. To illustrate, say we have two separate institutions, A and B, that come together to establish a contract. B issue a written document or a certificate or a promise to pay to A. In return, A transfer a certain amount of money agreed within the contract. So A will be the creditor and B becomes the debtor, something that we are familiar with. What happened here, the contract between A and B has raised an asset to A, a debtor, which is B, who promised to repay in the future. At the same time, the contract has also raised a liability in B, a creditor, which is A, who has transferred to B a certain agreed amount of cash to be repaid later. In between, B perhaps need to also pay some interest. So A becomes a creditor and B becomes a debtor. Now say that B issue bond instead, a document that promised the full nominal value of bond after a certain period. While A subscribed to the bond, thus transfer the present value of the bond to B in cash, which in return, A will receive interest until end of the promise period. So in this case, A becomes bondholder and B becomes bond issuer. A has an investment in bond as an asset, while B has a bond as a liability. Or if B issued shares, a certificate that showed the rights of the holder to B's equity, and A subscribed to the shares by transferring capital to B. In return, B will give dividend to A whenever possible. So in this case, A becomes shareholder while B becomes share issuer. So A has an investment in shares as an asset, while B has shares as its equity. For the specific definitions of financial liability, since we are talking about liability, the contract must be about liability. That is, it raises an obligation. Obligation to do what? To deliver cash or another financial asset to another entity. Or there is an obligation to exchange your financial assets or liabilities with the liabilities or assets of another entity that the net value is unfavorable to you. So in total, you are the one who end up owing the other entity or paying more than what you get from the other entity in the mutual exchange. So to have a financial liability, it becomes B, while the other party becomes A. Please note that in paragraph 13 of the standard, it says that the term contract and contractual refer to an agreement between two or more parties that has clear economic consequences, that the parties have little, if any, discretion to avoid, usually because the agreement is enforceable by law. So this means, by hook or by crook, legally, you have no other choice other than to deliver the obligation. Contracts, and thus financial instruments, may take a variety of forms and need not be in writing. And paragraph 14 of this standard says that the term entity includes individuals, partnerships, incorporated bodies, trusts, and government agencies. On the questions of when should we recognize the financial liability in our book of accounts or in our financial statements, it should be recognized when one becomes party to the contract, that is, if we become part of the agreement or contract. When we recognize financial liabilities, we should classify it according to paragraph 4.2.1 and 4.2.2. And at what value? We need to measure it based on paragraph 5.1.1. Now, how do we determine that we already become a party of a contract? Well, like we mentioned earlier, what counts is the agreement must already bind us with a certain obligation. Thus, it must be a point where the legal obligation is raised, or the obligation now becomes legal. It can be, if you're talking about written agreement, the moment that we sign the agreement, or if it is an oral agreement, the moment that we utter the agreed obligation to the other party with witnesses. In the future, you will come across a forward contract. That is a contract that legalizes the rights to purchase or the obligation to deliver certain goods sometime in the future at a certain price. So if the contract is a forward contract, we will have two separate dates. First date is the date when we legalize the obligation, which is called commitment date, and the other date is the future date where we deliver the obligation, which is the settlement date. So in this case, we become a party of the contract at the commitment date and not at settlement date. Another instrument is option contract. Like its name, it is an option to you. You may exercise the options or just ignore it when the time comes. For example, you purchase an option to give you the right to purchase a share at RM1.50 each, say in 6 months' time. After 6 months, that share might have a market price of RM1.20, for example, which is lower than what the option offers. Thus, in this case, it is wise for you to simply forget about the option and purchase the share in the open market. But if after 6 months, the share price has increased in the market to RM2, you might want to exercise the option and buy the share at RM1.50 as agreed in the option contract. So for this option contract, when should we recognize it? We should recognize it the moment that we engage with the option contract, and not when the other party decided whether to exercise the option or not to exercise the contract, i.e. 6 months later. And for planned future transactions or future obligation, the key word here is planned. This simply shows that the contract is not legalized yet, because it will only be legalized in the future. That is if we want to proceed with the plan. As for the classification, paragraph 4.2.1 posits that all financial liabilities must be subsequently measured at amortized cost. Now here, you might ask, why is the word measured being used? Are we not talking about classification instead? Basically, if you look into MFRS 9 financial instruments, classifying financial instruments becomes easier by the way it is measured, thus the word measured. In a way, it reminds us about how we should measure the financial instruments. So for financial liability, it should be at amortized cost. The word amortize simply means gradually written off the initial cost of either an asset or liability, but in this case a liability, over a period. Gradual means little by little, and write off means eliminating. Let me show you a couple examples. This is an amortized cost table of a loan. What you can see here, there is a principal, the actual amount of the loan or the actual amount borrowed. And we have interest, the return to the party who gives the loan. By the way, this is haram in Islam, but we are learning about non-Islamic contract, thus the interest, which is calculated by timing the principal with certain agreed or forced interest rate. In this case, it's 0.5%. So what happened here is, every month or year, depending on the agreement, we will make certain payment where within this amount there is a portion for paying the interest and a portion for paying the principal amounts that we owe. In the first year, for example, here we borrow 100,000 ringgit. That is the actual amount that we borrowed. Then after a period, we are charged a 0.5% interest, so we need to pay an interest of 500 ringgit. So for the first period, when we make the payments of 1,933 ringgit and 28 cent, from this amount, 500 is for the interest and the balance of 1,433 ringgit 28 cent is for the principal amount. Please note that the amount paid every period will be calculated by the banks. After the first year payment, we have a balance in our loan account of 98,566 ringgit and 72 cent, which is equivalent to 100,000 ringgit minus 1,433 ringgit and 28 cent, the principal, and not the entire amount of the payment made. I believe you already discussed this amortized table for loan in the previous course. Now please note that the period can be month or 6 months or year. If the agreement was to make payments every month, that means we are charged interest every month, thus monthly compounding. If the agreement was to make payments every year, that means we are charged interest every year, thus annual compounding. So this is how, in general, banks or financial institutions make money. Based on this table, throughout the 60 periods, we can see that the initial amounts of 100,000 is gradually reducing to zero or gradually written off until we paid all of that we owe. In this case, the principal plus the 0.5% interest. Thus, gradually reducing costs or amortized costs from the full amounts of 100,000 down to zero, where we already made full payment of the loan. This is another amortized cost table, but this time it is for a bond. You can see similar pattern here. You see the beginning amount, then cash payments every period. Within this payment, part of it is interest, and part of it is payments for the principal amount. And we can see that the initial cost or value is being amortized throughout the period, from the initial value or cost at 108,530 down to the nominal or face value of bond of 100,000, which this 100,000 will be paid in total lump sum at the end of the agreed period. So this is a slight different from our loan example just now. We will be discussing the nature of bond later, so if you are not getting it now, not to worry, okay? So we have discussed what it means by amortized costs. So if we have a financial liability, it should be classified as measured at amortized costs, except for those classified to be measured at fair value through profit and loss, financial guarantee, commitment to provide loan at below market interest rate, and contingent consideration by acquirer in business combination. Basically, the rest of the financial liabilities that are measured at other than amortized costs are those not suitable to be measured at amortized costs for some reason. The rules within amortized costs could not be applied to them. For now, we will just focus on amortized costs and bond. Just to highlight, the main idea behind allowing a different measurement is that it should give a much more relevant information about the financial liability. Besides, must be permitted by paragraph 4.2.5, which will be relevant when you have learned about other more complex financial instruments. The standard also prohibits reclassifications of financial liabilities from one classification to another throughout its lifetime. In terms of measurement, based on paragraph 5.1.1, except for trade receivables, all other financial instruments at initial recognition must be measured at fair value plus or minus transaction costs directly attributable to the acquisition or issue of the financial instruments. Now, why the standard give exemption or exception to trade receivable? It's simply because trade receivables always be settled at the amount owed and not likely be traded in the market, thus no market value. The value of the debt will be actual amount owed by a debtor. At most, it could change due to penalties for paying beyond the allowable period or late payment fees. For subsequent measurement, it follows the measurement in the classification as discussed earlier in paragraph 4.2.1 and 4.2.2. So basically, all financial liabilities should be measured subsequently at amortized costs, as in paragraph 4.2.1, or other relevant measures, as in paragraph 4.2.2. Just for a note, if we engage in financial instruments because we want to do hedging, we need to apply hedge accounting. But this is for later, once we get to the advanced course. Let us now look at the nature of bond. The idea of knowing the nature of bond is to understand how it works. What we are trying to do is to record and report the value and the change in value of this financial instrument. Therefore, we must first understand how it works or how its value changes through time. So here we have an example of a bond. Remember, we are now looking at a bond as a financial liability. Thus, we are the one issuing the bond and we receive cash from bondholders. Here we have a bond with a face value or nominal value of 100,000 ringgit. Bond usually issued in denominations of 1,000 ringgit. So if we want to issue 100,000 ringgit worth of bond, we need to issue 100 units of bond with a face value of 1,000 ringgit each. Each bond will also come with what we call a coupon rate, in this case 5%. This represents the return to bondholders that we promise to pay every period, either every month, every year, or semi-annually. This is also known as the interest of the bond and always times with the face value of the bond. Thus, in this case, every period we will need to pay bondholder 5,000 ringgit worth of return, regardless of whether we have made profit or we made loss for the period. In this case, the coupon bond is annually compounded, thus the payment will be made every end of year. And last but not least, this bond is for 5 years. Thus, this is known as maturity period. Therefore, if we were to present it in terms of a timeline, we have T0, the point where we issue the bond to bondholders, and at the end, we have T5, that is at the end of the 5th year. We will need to repay the nominal amount of the bond in lump sum, that is 100,000 ringgit. Throughout the 5-year period, every end of year, we also need to pay the promised return of 5,000 ringgit. So 5,000 ringgit at the end of each year until end of year 5. So at the end of year 5, not only that we pay the nominal amounts of 100,000 ringgit, we also need to pay the promised return of 5,000 ringgit. Now these similar payments of 5,000 ringgit that we made every end of period is what we call annuity. It is called annuity simply because the amount paid is fixed at exactly the same amount every period. Now how about the value at the inception of the bond, or when we issue bond? What would be the price? As mentioned earlier, the standard requires it to be at fair value, and this means since we are talking about amount paid every end of future periods and at maturity, thus the value must be at present value. Therefore, it will depend on the market interest or effective interest or yield to maturity interest, and whether the interest is lower or higher than the coupon rate. Now, if the effective interest rate is lower than the coupon rate, the fair value at the inception is expected to be at premium. This simply means higher than the nominal value. If the effective interest rate is higher than the coupon rate, the fair value at the inception is expected to be a discount. This simply means lower than the nominal value. Or we can look at it this way. We offer investors to subscribe to our bond, lend us their money, and we promise to pay 5% return every year. But the market, that means other firms in the market, offer similar bond or investment and promise to pay 8% return every year. So do you think that investors will come to us or to the other firms? Definitely to other firms, right? Because they offer a much higher return. But we're desperately in need of the capital. So what do you think we should do? Yes, we offer the bond at a discount. Give us 80,000 ringgit. That is a discount of 20,000 ringgit from the nominal value. We promise to give a return of 5,000 ringgit every year, and at maturity, we give back not 80,000 but 100,000 ringgit, which is the nominal value. Now, do you think investors will be attracted to our bond? I think so. Or it can be the other way around. We offer to pay a return at 5%, while the rest of the firms in the market only offer 3%. Do you think investors will come running to us? Definitely, since we offer a much higher return. But now, we have many investors, but we need only a few. So we offer to those who could provide us a higher value at inception, thus at premium, greater than the nominal value. For example, at 105,000 ringgit instead of 100,000 ringgit. Then we promise a return of 5,000 ringgit at every end of the year, and at maturity we paid the full nominal value of 100,000 ringgit. Investors will not mind at all because we promise annual return that is much higher than what they can get elsewhere. So now we know at maturity we must pay the nominal value regardless of how much we receive at inception, lower or higher than the nominal value. Thus, if we were to issue at premium, we will start with a value more than the nominal value, in this case more than 100,000 ringgit, and throughout the bond period, we expect the amortized cost table will show us a reduction in the value from more than 100,000 to its nominal value of 100,000 ringgit. On the other hand, if we were to issue at discount, we will start with a value less than the nominal value, in this case less than 100,000 ringgit, and throughout the bond periods, we expect the amortized cost table will show us an increase in the value from less than 100,000 ringgit to its nominal value of 100,000 ringgit. So to calculate the bond value at inception, it will be the present value of each payment made at the end of every period, the coupon payment, and at maturity, the nominal amount and the final coupon payment. So the formula is like this, where P is the price or value of bond at present or its fair value as at that date. N is the periods until maturity or number of payments. Remember, if the bond is monthly compounding, thus we will need to make payment every month or 12 times a year. If the bond is semi-annually compounded, we will need to make payment every 6 months or 2 times a year. If the bond is annually compounded, we will need to make payment every year or once or 1 time every year. C is the coupon rate, which will determine the annuity amount, simply timing the coupon rate with the nominal amount. I is the effective interest rate, or also known as yield to maturity rate or market rate. And finally, M is the nominal or face value of the bond. So the price of the bond is equivalent to the summations of the present value of coupon payments every period, or the annuity payment, plus the present value of the nominal bond value at maturity. Now say for example, the effective interest or market interest is at 7%, which is higher than our coupon rate, so we can imagine what value we might get, right? Correct, lower than the nominal value. If we use the formula in previous slide, this is how we write it down. Present value of annuity of 5,000 ringgit and nominal value at maturity, all at the effective rate of 7%. You can calculate it using your scientific calculator, or you may use online calculator, for example the one here. The online calculator, using the formula, will give us a value of 91,799 ringgit and 60 cents. Or you may use the present value table, since we already know that we need to present value all the annuity and the nominal value at maturity. This is how we write it. So if you look at the present value table, look for the rate 7% effective rate, and look for the number of periods till maturity. In this case, the bond is annually compounded and the period is 5 years, so N equivalent to 5. So we will use the factor from period 1 at 7% of 0.935 for annuity year 1 and so on until year 5 of 0.713. So basically, we will have the formula like this. Just plug in all the present value factors. This will give us 91,800 ringgit, and this is an approximation. Please remember that the actual factor value could be 6 or 7 decimal places. Thus, if you use a different present value table with a different decimal place, it will give a slightly different N value. Remember when I used the formula, it gives us 91,799 ringgit 60 cents, a slightly different value or a more accurate value. Now let's say the bond actually compounded semi-annually. That means we will need to pay the coupon twice in a year, at half of the annual value. Therefore, the annuity will change to 2,500 for every 6 months. That is half of the annual coupon payment. This also means that the number of periods for payment increased to 10. We also need to divide the effective rate by 2. So instead of 7%, the effective interest now is 3.5%. That is half of 7% annual interest because the bond is now compounded twice a year. The factor, therefore, will also need to be at 3.5%. Since in this table we do not have 3.5%, we need to do some calculation to estimate the value for 3.5%. For example, for period 1, the factor for 3.5% is between 0.971 and 0.962. Thus the difference is 0.009. So to get to the factor value for 3.5%, we can divide 0.009 by 2, and that will give us 0.0045. Note that the factor is actually decreasing from 3% rate to 4% rate. Thus the factor for 3.5% will be 0.971 minus 0.0045, and that gives us 0.9665. And finally, to calculate the bond value, we need to calculate the factor for 3.5% rate for period 1 until period 10. Another way to calculate the bond value is like this, using both present value annuity table and present value table. We use present value annuity table for annuity of 5,000 ringgit, and we use present value table for the nominal amount at maturity. At 7% and period 5, we will times the annuity of 5,000 ringgit with annuity factor of 4.1 and added that to the nominal value times the present value factor of 0.713. So we will end up with 91,800 at the discount, equivalent to the value that we get when we use present value table only. But by using annuity factor, we make the calculation shorter. Again, please remember that we need to amend the effective rate and thus the factor value for annuity if the coupon was paid semi-annually or monthly. Now what if the effective interest changed to 3% and the bond compounded annually? We use the factor at 3% and period 5 for both present value annuity and present value. So we have present value annuity factor of 4.58 and present value factor of 0.863. That gives us the bond value of 109,200, which is at premium. Now it's your turn. I will let you try to calculate the bond value using the present value annuity and present value tables provided. Here we have bonds for firm A and firm B, both with the same face value of 1 million ringgit, maturity period of 10 years, coupon rate of 8%, and effective interest rate of 7% for firm A and 9% for firm B. Let's assume the bonds are annually compounded. Now please pause this video and do your calculation. Resume to play the video once you're done with your calculation. Did you manage to calculate the bond value? For firm A, it is equivalent to 1,069,920 ringgit, and for firm B, it is 935,440 ringgit. So it is at premium for firm A and at discount for firm B. Now that you know how to calculate the initial value of your bond or bond price at issuance or at its inception, you can now draw the amortized cost table for your bond. Let me illustrate to you using firm A. From the left, we have column year, since for this firm, the bond is annually compounded, or it could be changed to period. Then we have the beginning amount. This will be the amount at the beginning of the year, starting with the initial value of bond that you have calculated. This is the effective interest column. The rate could be more accurate if we were to use formula, but for simplicity purposes, let us just stick to 7%. This interest will be the amounts of interest expense that we need to record in the book of accounts. All we need to do is to time this rate with the beginning amount, for this case at the end of every year. Then we have coupon interest paid or coupon payment. This is the fixed return that we need to pay our bondholders every year. Like I mentioned earlier, we simply time the coupon rate with the nominal value of bond to get to the amount. Then for this particular case, Firm A has issued its bond at premium, that is at a value greater than its nominal value. As I showed previously, if we issued bond at premium, we need to reduce the amounts of premium to get to the nominal value. This amount is derived by netting the coupon amount paid to bondholders and the amounts of interest expense for the period. At the very end, we have ending balance column. This is simply derived by netting the beginning amount and the premium amortization amount. So if we take the calculated value of Firm A's bond just now, we will start with the beginning amounts of 1,069,920 ringgit. Then from this amount, we can calculate the interest expense at the end of the year of 74,894.40 cents. Deducting this amount from the coupon paid, we will have a balance of 5,105 ringgit and 60 cents, which will be the amortization amount for the premium. And that gives us an ending balance of 1,064,814 ringgit 40 cents. This ending balance will be the beginning balance for period 2, or year 2 in this case. We will do the same process at the end of the second period or second year to calculate the interest expense and the amortized amounts of premium, and we end up with a new ending balance. We will continue doing this until end of year 10, where we should get approximately the nominal value of the bond. Now remember, from the calculation, we might end up with a slight deviation from the nominal value, perhaps few cents. And this depends on the accuracy of the calculation. If used formula, we could get much closer to the nominal value at the end as compared to using a simplified present value annuity and present value tables. You may also use Excel spreadsheet to help you with this, as it has embedded all the necessary formulas needed to do the amortization table. For banks and financial institutions though, they basically have computerized system to do these tedious calculations to be as accurate as possible. So not to worry much about this, but definitely you need to know how these values are derived to understand the recording later. You may continue to calculate these values in your own free time to get a complete amortized cost table for bond of Firm A and Firm B.